Good morning, my name is Philippa Shipley. I'm Product Developer at Global Investor Group, and it is my pleasure to welcome you all to the FAW European Derivatives Conference. I'm very happy to be introducing myself today and look forward to getting to know you all better. We have an exciting two-day event ahead of us. On the agenda today, we are kicking things off with the SGX Breakfast Briefing, which will take a critical look at FX futures within Europe, in conjunction with Uncleared Margin Rules. Following that, we turn our attention to the exchange landscape. As new exchanges come to market, we ask a simple question. How many exchanges are too many, and who should be setting the rules for regulation? Closing day one, all eyes turn to Asia. Our expert panel will be discussing the opportunities coming to Europe with the internationalization of the Asian markets. Extending trading hours means global reach. What will come from this? Tomorrow, our opening session looks at the higher costs of trading and what this means for market structure. And of course, we can't discuss any market without looking at ESG. Our panel will be assessing whether ESG factors really do add value to the product, while also exploring the ways in which derivatives can be used to facilitate capital flow to ESG projects themselves. Closing day two and the event, our final panel will be looking at the commodity supercycle, with a particular focus on environmental, energy, and metals. Can our experts forecast the market for these? We will see. This day is not only to hear from our speakers, but we'd also like to hear from you. We encourage you to ask questions throughout each session, which you can do via the chat function on your screen. If you have any technical issues, please contact the Global Investor team via the help desk and swap card. We also want to remind you that the sessions are being recorded and will be available to view on demand. And finally, I would like to send out a big thank you to our sponsors: Euronext, B3, CBOE, ABN AMRO Clearing, BME, JPX, Singapore Exchange, TMX Group, and Vienna Stock Exchange. Thank you also to our media partners, Crypto Academy, European Venues and Intermediaries Association, and FinTech Ireland. Now, I'd like to hand over to Chris Wright, Asia Editor for Euromoney magazine, to get us started with the SGX Breakfast Briefing.
Thank you, Philippa. Good morning to you in Europe. Good afternoon from here in Singapore, and welcome to the SGX Breakfast Briefing, FX derivatives markets amidst COVID-19 and UMR. My name's Chris Wright. I'm the Asia editor of Euromoney magazine, and I will be your moderator today. We speak, of course, at a time of significant disruption, socially, geopolitically, medically, and in regulation. On one hand, we have COVID-19 still troublingly front of mind more than a year after we first found we could speak of little else. And in our world of derivatives, we have the considerable regulatory impact of Uncleared Margin Rules, or UMR, still working their way through their various phases and with much adaptation still to come. It's a perilous environment, but here to help us understand it is an excellent panel boasting a wide range of expertise. So let me take a moment to introduce them. Here in Singapore, Casey Lam is Senior Vice President and Head of Foreign Exchange and Rates at SGX, Singapore Stock Exchange, but apart from being a stock exchange, increasingly a multi-asset class exchange and a regional leader in the derivatives field. Chris Callender is Head of FX Futures and Sales and Trading at Societe Generale, SG, and he is joined by Nicholas Gregor in FX Structuring for European corporate and institutional clients, who we will turn to when things turn technical. Mark Potter is Head of Trading at TransTrend, which is a CTA based in Rotterdam. And Richard Turner is Senior Trader at Insight Investment, a specialist global asset manager headquartered in the UK. Richard's specialist area is algorithmic trading for FX and equity products. And just as important are you, the audience. We invite you to put your questions forward. I should be able to see them in my chat window, and we'll be glad to incorporate you and your queries into our event this morning. Okay, there's plenty of ground to cover, so let's get started. I want to start with a broad question to set the scene. It is, as we've already discovered, an ever-changing FX market where liquidity is fragmented, where regulation is increasing and evolving. In this environment, what are the alternate liquidity sources, tools, and platforms available to financial market participants? Casey, would you like to get us started?
Sure, thanks, Chris. I think one of the things that we have noticed is in the last couple of years, and now especially, is the fact that the market actually is quite fragmented in terms of liquidity. It's getting also more complex. Obviously, there's increased regulations. We have different mix of participants. It used to be the sell-side banks are doing market making, and now we have non-banks participating as well. We have many different venues. We have central limit order book, CLOPs, MDPs, the multi-dealer portal, and then we have venues that recycle liquidity as well. So in all this mix as well, all the big primary venue, what we call primary venue, where pricing is being discovered, such as like the world of EBS and even Refinitiv. We are seeing them reducing their lot size for the matching of trades, So there are a lot of implications on this. So if you look at trades that are usually listen about before you trade, now they are even allowing small lots to come in. So there are implications of what that means on top of the book, what bid-ask spreads would imply. And at the same time, it's kind of funny, I just mentioned that thinking of what EBS and Refinitiv is doing with smaller lots, we are trying on our hand, SGX, trying to increase our lot size. We're now upsizing our contracts to at least 100K per contract, right? And that is something that is interesting. So we are still, if you look at FX futures as an alternative liquidity source to OTC FX, I have to say, the FX futures as a whole globally is still a small chunk of the OTC futures or OTC FX market. However, it's actually growing very fast. So that's one takeaway. The other takeaway is to note is that if you just peel the onion a bit and look at FX currency contracts and look at the volume and liquidity by FX pairs, you will notice that the Asian currency is at least in the futures format. So definitely dollar CNH and INR, the NDF contracts. We actually have in terms of liquidity, any venue, way surpass that on some of the primary venues for OTC. So which is kind of interesting. I mean, in totality, it's probably a small chunk of it. If you look at individual currency pairs and so on, the Asian currency pairs have a higher degree of futurization as compared to, say, other contracts in the market. So for example, in CNH terms, we are trading close to 5 yards of dollar CNH a day. On average, I think right now this month is around 4 yards, slightly less. In Indian rupee, we are above 2 yards a day. So just to point that this a good, fair, open, and transparent market that is actually listed in the landscape of FX market.
Thank you, Casey. Let me turn to Chris Callender. Let's get the bank's perspective here. Do you want to just follow on from that, say what you're seeing and what the sort of current priorities and needs of the market are?
I think it's an interesting use of the word that Casey uses as primary venue. We've actually seen on the spot side, on the futures side, kind of more volume in some areas on G10 spot, like via the exchange and the ETD environment, rather than actually in the kind of like the classic kind of the spot matching environment. And we've seen over the last, say, 2 or 3 years or so, a lot more of an entrance from the buy side, but also the sell side, and you say the non-bank sell side coming in as well, kind of like adding liquidity. And there's a certain definite switch in kind of like focus, rather than just on the kind of the classic kind of matching kind of systems, than just like than we've seen before. So like the listed side of things is becoming much more of a kind of prevalent venue. So
yes. Why is that, do you think? Why is the listed side of things becoming more of a prevalent venue?
It's a variety of different reasons. I mean, obviously, you're going to do the headline kind of thing about UMR, but it's also kind of like the transparency of the actual central limit order book itself. I think you've seen kind of like a lot more people looking at the like best execution, like adding more kind of tools to their liquidity environment. So, and the market's becoming more sophisticated. You know, we saw the ETD environment kind of like drop off towards the kind of the beginning of the 2010, 11, 12, 13, 14s or so, but it's kind of really since, I'd say 2017, 18 or so, become very much more of a, you know, it was say like 5% of the market, you know, in terms of primary venue, but now it's like, it's really started to become like an object point and a point of discussion amongst the, you know, the dealers.
Yes, yes, interesting. Well, let's get some perspectives from the investor side. So, Mark, as we've discussed, a fragmented environment, which creates opportunity, a greater range of things that you can do, but perhaps also something of a burden in terms of resources and what you need to be across and the need for transparency. Do you want to address that and tell me how this environment affects you?
Sure. You know, it's definitely a challenge, you know, on the trading desk to find the liquidity where it's most prevalent. You know, for us as a CTA, you know, we trade futures, our bread and butter is futures, so we prefer everything in futures. Our ideal situation would be everything is on the screen, you know, and then whichever exchange has the most liquidity. But with the fragmentation, I think our job is to, you know, source the liquidity where it is and, you know, to be creative. We're talking about numbers of what kind of volumes are on exchange or what have you. But there's, you know, more than one way to get there. You know, so we try to use, you know, EFPs to get posted onto the exchange. We use blocks. And in order to do that, we need to, you know, set up systems and counterparties that are willing and able to provide these services. And you know, it's not something that's achieved within one phone call. So you know, it's definitely a challenge in order to get, you know, the best pricing for what we want to get, but also to have the product in the end of the day.
So what does that require? Is it tech spend? Is it more headcount? Is it just time? What
yeah, I think the biggest challenge is to find the counterparties in order to provide everything you would like to have. And then, of course, if you would like to be to have it efficient on the trading desk, then you need tech as well in order to, you know, for the traders on the desk to make it look but all the same, to make it look all the same.
Right,
Absolutely.
right. So, all told, is a fragmented market better or worse for you? Is it better in that there's a greater range of places you can go to for liquidity, or worse because of the burden of being across it all?
I think if you had unlimited resources, it might be okay. So you'd be able to go shopping everywhere possible while others cannot. So then you would have a competitive advantage. But I am quite sure with a lot of people listening in, we do not have unlimited resources. So you have to pick and choose. And that pick and choose, you always have to drop something.
Yes, sure. Well, Richard, let me ask you to follow up from that. Is the environment that Mark is describing chiming with your experience?
Yeah, absolutely. I mean, I think our you know, our job has become very not difficult but interesting. I think we to echo what Mark was saying, we have to make sure that liquidity we're speaking to is right for us, and that it does, you know, does what it says on the tin. So we spend a lot of time looking at best execution, looking at transparency, making sure that when we do execute in the market, it is executing in the right way. So at Insight, we spend a lot of time curating liquidity pools, looking at various sources of liquidity. And to be frank, that can be any sort of liquidity. So it could be futures, it can be OTC, you know, it can be any type of liquidity that we look for. And really, it's the quality of liquidity that we really care about. I did like Casey's sort of analogy of an onion, liquidity being a sort of an onion. You sort of slice back the peel back the layers, and I think that's exactly what we're facing at the minute. But you know, as I say, at Insight, we spend a lot of time looking at things, you know, such as impact of when you do trade, and you know, impact versus cost saving. You know, is it the right sort of mix for you at the time of trade? So we spend a lot of time analysing that. And just to sort of reiterate what Mark was saying as well, there's a huge pressure. There is a huge pressure at Insight around resourcing and how you get resources to do anything you want. So I spend a lot of time trying to get some smart fixes, which, you know, don't necessarily use up all the resource, because there is a lot of competing pressures for resource, particularly with all the regulations that come in and also just, you know, from BAU when, you know, when you have to spend resources and things that you are unforeseen that come across your desk. So resourcing for us is a huge factor.
Sure. And you mentioned the importance of transparency. How good is it now? And I assume the picture probably varies from one element of the market to another, but just expand on that a little.
Yeah, so I mean, we challenge, I spend a lot of time in the weeds, if you were. So when we're trading electronically, I'll be looking at child fills and looking at the data we get from the people that we execute with. So I spend a lot of time looking into the weeds, and I find at the minute that, you know, transparency varies across the street, but inexorably we challenge our counterparties to provide transparency, and you know, if we've got a panel of 10 counterparties providing liquidity and 8 of them provide us the transparency we want and 2 don't, well, you know, the commercial decision is very straightforward to see there.
Yeah, okay. I'm going to quickly come back to SG, just in light of what you've heard from the investors there. What do you make of what you're hearing? And is there a way that you and your role can assist with some of the challenges that this part of the market faces?
I'd agree. I think realistically, whilst we're looking at things like UMR, which as a top line banner, so to speak, it says that this is why everyone's going to an ETD environment. Realistically, I think transparency is the most important thing. You know, the question about best execution, all that type of stuff. Going to kind of like bilateral banks where you're talking about best execution, the transparency, I think has been, I would say, up there towards 50% of the reason why the market has moved towards this way. And whilst the market has fragmented to a certain extent towards the idea of where the trades are being placed, the kind of like the essential liquidity providers to a certain extent are still there. It's just a question of, you know, how do you access liquidity via which source, and also once you've got that liquidity that you've enabled to achieve, where do you then park your position? You know, for market would be, you know, for instance, the CTA, you'd want to put that, you know, do you want to futurize it, so to speak, as an EFP? But for other asset managers or for other kind of counterparts, you'd want to put that into either bilateral relations or PB relations. So the questions that we've seen can like arrive over the last couple of years is like, you know, obviously the best execution, but the cost of execution plus the cost of holding the trade over a certain period of time. And do you hold that on exchange? Do you hold that on a kind of like a cleared environment? Do you hold that in a PB environment, or do you hold that in a bilateral environment? I think that's the kind of the, not the bifurcation of the market, but kind of like the understanding that first you've got the liquidity that comes and the best execution that comes with that. Then you've got the question of the best execution of holding that position, or the best cost of holding that position. And that's what we found, like I say, from about 2017, 2018 onward, has been the you know, the huge question.
Absolutely. Is this perhaps a moment to turn to Nicholas just to look into a little more detail about the practical side of that calculation, the cost of the position, that sort of thing?
Yes, sure. I mean, we'll discuss it a bit maybe into more detail further, but indeed, if you compare the two worlds, the OTC world versus the clear world, the cost structure of those two type of formats can be a bit different. So in a bilateral world, assuming that the client doesn't post any IA when trading or doesn't trade with a PB, this client will have a pretty transparent price and costs that will be reflected directly in the bid-offer spread shown to him. While if you look at the listed world or the cleared world, here the cost structure is slightly different. You'll have obviously some transparency, pretty transparent costs that will be upfront, such as the exchange fees or clearing fees, but you'll have also additional costs that are here a bit less transparent per se, which will be running costs, such as the cost of funding initial margins. And why am I saying that these costs might be hard to assess is because first, the initial margining might be variable in time. So we have seen lots of volatility, especially during COVID, on the initial margin that has been asked by clearing to the counterparties, to different counterparties. And also, obviously, the cost of funding this initial margin will vary as well, depending on the market situation. So, for banks, for example, these costs have significantly increased during COVID because the liquidity was has shrunk significantly during that time. So it gives a bit more uncertainty overall on how much you will end up pay in your as an overall cost when trading futures.
Great. Okay. Thank you. Thank you. Well, let me turn back to KC. The subject of UMR has been raised a couple of times already. We can't avoid it, of course. It's been around since 2016 in its first 4 phases, but there is perhaps a sense that it's only now that phases 5 and 6, which have a far greater range of influence, are really coming to bear. So we'll get a few perspectives on UMR, but let me start with the exchange perspective. How are exchanges meeting the demand for quality liquidity and platforms in a volatile and uncertain market in light of UMR?
Yeah, I think before maybe we touch on the readiness of exchange or venues on how, or even clearinghouse on how they handle UMR. If we look at the recent survey done, well, it's not so recent, it was done last year by State Street, where they took up 300 financial institutions that will be subjected to phase 5 and some of them phase 6 of the UMR rollout. Phase 5 being on September this year and phase 6 on September next year. It's interesting that the statistics, this is as of, I believe as August last year, 19% of all the 300 financial institutions surveyed are fully prepared for the UMR, right? The rest of them are starting to prepare or just thinking of preparing, which is a very, very scary number, right? We are quite close. I mean, UMR granted last year was kicked, to 1 year later. It was delayed by a year, and I think the state of readiness, the state of play, actually is quite scary. That many of the financial institutions are not ready. Of the 19% that are fully prepared, 56% are planning to adjust their trading strategies to reduce OTC FX contracts to limit the impact of UMR. So what it means is that they are looking at portfolio, optimizing the portfolio, maybe moving some of the futures, some into clearing. The reason why there's a lot of work to be done before the UMR they're ready for UMR is that there are a lot of things that they need to do, such as a decision on segregated collateral, right? Discussing with their lawyers on what model of initial margin to use, whether you're using a same model or a standard schedule model. What strategies do you need to basically adjust a position, and would they be using compression to reduce the impact, and so on and so forth. There are a lot of work needed to be done. The UMR, we believe, is a perfect storm that's going to impact credit. So the likes of FXPB, for instance, those guys who are offering the credit right now will somehow be impacted, and the liquidity in FX market. So you have a situation potentially that UMR could create a bifurcation of market where you can see a world of cleared liquidity versus uncleared liquidity. And you potentially, it's like similar to the time when SEF was implemented here in North America, where you have SEF and non-SEF liquidity. You bifurcate the community into two. So one is SEF liquidity, one is non-SEF liquidity. On our exchange side, we pivoted away from clearing of OTC for SGX. We pivoted away from clearing of OTC to basically allowing futures and futures only. So what we have done is that we introduced what we call Flexi Futures, which allows futures to mimic or replicate, I think the right word is probably replicate, an OTC exposure in forwards and swaps, that they can actually move into futures, right? Granted, FX forward and FX swaps are not covered under UMR, but they are counted under UMR. So that's the issue of really a trader from the position of moving everything into a more efficient model, such as futurizing it or not, they can actually achieve a lower cost of capital or more efficient use of capital. We believe that in SGX, we believe that the world will probably evolve into a world where you have cleared OTC, FX, those are impacted by UMR, totally uncleared as it is right now, some of it, and futures trading. So they will coexist in a sense. So I don't think I think the world will evolve, and it's not going to be a big revolution to trade futures, but it will slowly come together. So on our end, we are offering futures. We are launching our futures contract. We have launched Flexi Futures already. It's been traded, proven to be working. So we hope to see that UMR potentially could impact some of this trend as well in terms of moving to futurize some of the portfolio. Thank you.
Okay. I mean, you describe it as a perfect storm, but you do also paint a picture of a workable method of getting through it. I mean, in aggregate, are you nervous, or you think the industry can handle this, just provided they have a bit of time to get on top of it?
I don't know. I mean, it seems that every time we come close to a deadline, they kick the can down the road a bit more. So it's anyone's guess.
Yes, kicking the can down the road, tried and tested method of making it tomorrow.
But Chris, having said that, right, I think one of the things that a lot of buy side that we spoke to, at least some of the buy side we spoke to, are very reliant on their PB, the FX PB, for instance, to tell them what to do. So in this case, they are probably conflicted in basically telling them to move into a more efficient model, which is futures, because their world is OTC FX. They may not be able to offer that kind of coverage when UMR kicks in. But in between now and then, to have the customer move away from engaging them is actually, there is a interesting conflict there. And why would they do that? And they are so dependent on FXPB anyway to tell them exactly what system to use, what platform, and so on and so forth. So I find it an interesting challenge.
Right, okay. Just a reminder to our audience, please do send questions in. We'd love to hear from you. We'd love to hear what you want to know so that we can help you address it. But sticking with UMR, let me turn to the investors again. Mark, what do you make of what you've heard, and how much does UMR impinge on your general working day?
For at Transcend, we are not directly affected by UMR, but with the advent of UMR, at first I was quite excited about it, that would bring more players to the cleared market. That would be a better environment for us. I think essential clearing I think could be seen as an important step to get more to a direction of a central limit order book, where we would be much happier in that environment. But as KC was talking about, you're actually seeing more of that fragmentation in the market. You're going to get pricing for cleared FX. You're going to get pricing for uncleared FX. You get pricing to post onto an exchange. So that actually presents even more challenges, and exactly what Rich was talking about before, the quality of liquidity. What am I looking at now, actually? But then again, with all these challenges, there are opportunities, right? I think there's an opportunity for service providers to step in order to perhaps provide some kind of translation services, that they are able to provide all of these products at the same time. So it doesn't matter. I don't need to call someone up or electronically, what have you, and say, I need this kind of product. I need that kind of product. I need this kind of product. I want to say, no, I want $yen. And this is what I'd like to do. And then the service provider will, help us figure out where it needs to get cleared or non-cleared and what have you.
Interesting idea. Where would you look to for a service like that? Who are, at least generically, natural candidates to step into that gap, do you think?
I think just thinking out loud, I think an exchange or a clearinghouse would be able to do that because they have everything coming in. I'd say a bank would be able to do it, but then, would there be too much fat on the bone for them to take from the trade? I don't know. It's not a completely thought out process yet, but I think there are opportunities there for sure. And exchanges do it, that you're able to block on or EFP on. There are service providers, such as SocGen with Chris, that I can trade with him and I can have it as OTC, or he can post it to an exchange. So there are possibilities there for sure.
Sure. Well, I'll ask SocGen to respond to that in just a sec. I'll come to Richard first, just to ask you to just follow up on that once again. UMR, the impact on you, and whether you perceive the perfect storm that Casey has described.
Yeah, no, I think I sort of agree with Mark. The fragmentation in the market is, it's just growing, and I think, again, from my perspective, we don't really care where we trade as long as it's the best price and it's the liquidity that we can utilize. We trade electronically. OTC majority of the time is our flow at the minute. If that changes to futures, then we'll have to make the UMR for us is really being kicked down the road and eventually is opened. Then that will be the point at which we may well have to change our model in how we access liquidity.
Great. I'm just losing you there, Richard. I apologize. I don't know if there's a connection issue, but I'm just going to turn across to Chris. I'm sorry if you were still speaking, but we have lost you just for a second. So we were hearing before that perhaps there's an opportunity here for banks to step in, provide intermediate services relating to the challenges that come from UMR. Let me ask you to respond to that, and also just to give me your impressions of just how big an impact we're going to see from all of this.
Well, I think there's two things I'd like to say on that. Firstly, I think a lot of people have got sore toes from kicking that can. It's been a painful process for everybody, from the banks down to whichever counterparty. And the funny thing is that just before the crisis, every other conversation or every third conversation I had would be about UMR and how that's going to change the environment, etc. How we're going to be in 2022, 23. Is it going to be a cleared landscape? Is it going to be on a central limit order book, etc. But those conversations kind of died a death towards the middle of last year with the COVID crisis. So the question is, are we going to get very busy over summer and this summer and next summer? We're going to have a lot of lawyers running around again who didn't have to do with Brexit and charge some nice hourly fees on kind of like advising on the new rules. That's the first point, and I think that's been kind of like the general movement, like I say, like for the last couple of years, where we've seen people potentially, in the next 4 or 5 years, moving towards a kind of central limit order book environment. But realistically, I mean, if we look at what the exchanges are doing, you're seeing kind of a movement towards like purchase of or mergers with kind of like aggregators that they have on their side. So, for instance, with the SGX, you've got the BidFX kind of side of things. You've got other exchanges that have actually merged with or kind of like taken over other aggregators, and you wonder whether they're going to take this. And again, going back to what Richard said, take this tech, whether they're going to kind of put it all together into kind of like an environment where, yes, Mark could say he wants to trade dollar yen, click a button, get that liquidity, and then push it to whichever, like I say, whichever holding, whichever kind of like a destination position he wants. He will aggregate the spot liquidity, he might aggregate the futures liquidity, he might aggregate some fixed income liquidity basically from the basis, and he'll go, right, I want to put X amount into futures, X amount into OTC, and I want to keep this as a balance conversion for spot, right? And I think in 5 years we'll be there. I said this 10 years ago. But I think we've moved a lot further than we were in well, certainly in 2014 when the Rule 538 came out, but we've moved a lot further in the last 3 or 4 years than we have done than I would imagine. So yeah, time will tell over the next couple of years.
Casey, any thoughts on what you've heard and perhaps what this means? Is it an opportunity for you?
Well, I agree with what Chris outlined earlier in terms of the bridge, I would use the word bridge, between OTC and futures. This is definitely coming closer to each other. There would be a situation where that's actually what we're trying to do with BidFX when we acquired BidFX, is to enable OTC participants using BidFX, buy side especially, to be able to look at trading futures seamlessly as well as doing OTC. And there could be a lot of things that we could do with it. Right now, today, on the BidFX platform, you could pull out a screen and they will show you a futures price in OTC format. What that means is, let's take, for example, the typical futures format for NDF currency is always inverted, or rather, different views from what the OTC traders are used to seeing on screen. So you'll be displayed as INR dollar as opposed to dollar INR. It's just the inversion. It drives traders crazy, but it is what it is, right? But with BidFX, what we could do with them is to basically offer the GUI where they can display, in dollar INR terms. So it's a bit convoluted in the sense that bid become offer become bid, but traders can realize that, sometimes there are pricing efficiency in the FX world that, or rather the price source from BidFX and those exchange could differ, and that could be a trading opportunity as well. So it is interesting to see. We're going to roll this out, and more customers will be able to get access through BidFX venue, just for example. And we do have potential to create newer products where our sell-side banks can participate, where they are really in a position to participate as well, to offer a bridging liquidity between OTC and futures in an electronic format. SocGen and Chris could actually do that. What we think of it as an EFP, but is traded on screen, where you can physically change from spot to futures and vice versa, traded on screen, or basis trading that can happen. Those are the things that product innovation can introduce with such a venue working closely to each other.
Yes, absolutely. I think there's scope to talk more about an issue that was raised briefly earlier around counterpart risk, the impact on trading behavior, collateral optimization, other issues like that. Who would like to take that? Maybe I should give Richard, who I see has now rejoined us, the opportunity to speak on that first. I see you in glorious Technicolor now. Good to have you back.
Apologies for that. I'm not sure. I think my connection was a bit weak then. But no, I mean, it's again, for us, the key thing is sourcing liquidity. And what that means in respect to what you've mentioned there is that the liquidity we see, must have all the correct pricings in the background. So all the costings, all the costings associated with that price must be transparent. And so for us, the price that you trade, wherever it comes from, needs to have in it the variance and the different margin costs and so on and so forth, for it to be tradable in our environment. So I think that's the most key thing is the transparency around the price and everything that goes into coming into that price. That's the key thing for us there.
Sure. Mark, anything to add on that theme?
Yeah, with transparency, when you're talking about the counterparty risks, whether you're bilateral or whether you're the fees that you have to pay in exchange, or you have your PB agreements and what have you, it's our task on the desk in order to make it visual for us. What are the costs per avenue? But something that I don't think gets mentioned enough is your internal costs. How much time are your colleagues spending on opening these avenues, keeping them open, and how you're using them. If the more fragmentation we get, the more avenues we want to participate in order to get the best liquidity possible. But it also costs a lot more time. You have to start hiring more people in order to do all this. That's also an enormous cost of trade there. So that's something that we have to be very mindful of, that we are mindful of. So yeah, it's definitely a factor.
Sure. Okay, and Chris, and also Nicholas, on this question of increased awareness of counterpart risk. Any more to say on that and the role that's there for you?
Yes, sure. So I think it is correct to say that buy-side community has been has become increasingly aware of those counterparty risks. However, this community is so diversified, large, that I think that the counterparty risk itself, from some of them, might not be relevant enough to change their trading behavior. For the buy-side client, having constraints or being more sensitive to counterparty risks, they can, of course, use now the offer of or the alternative given by the exchanges, which are the FX cleared, OTC cleared, or listed format of trades, and therefore switch from a bilateral position and a bilateral risk to CCP risks. But it also exists for some of buy-side community other alternative to improve or to protect themselves better against these counterparty risks. For example, we have seen some large asset managers that are highly rated and who have been aware of the counterparty risk for years now, and have imposed some minimum requirements in terms of credit rating to banks when they were willing to trade with them. And this is purely on the OTC on the OTC format. And these minimum requirements were included and agreed in the legal documentations they signed at the time. So there are alternatives to cleared and listed solutions in order to gain some protection, additional protection against counterparty risk. Basically, without changing in a way your trading behavior. Now, if you look at the bank point of view, we have significant capital immobilized led by the counterparty risks. So we have been aware and we have monitored for years these counterparty risks. And the cleared, OTC cleared instrument and listed instrument can be, I think, great tools now for the banks in order to minimize this capital immobilization. And it's also an instrument that will have compressing the overall exposure that we'll have facing certain entities that are more or less risky. So overall, it gives more possibilities to banks to optimize their capital consumption.
I think we've seen as well over the last couple of years, more players from the bank side enter this market. And it's going to make, as we've been saying, there's a balance for the buy side to turn around and saying, well, where's the payoff between the cost of the tech and the cost of the analysis, as Mark was saying, versus the cost savings they're going to have into whichever product they're going to put it in. So it's do you go to an exchange and say, can you do analysis of my position or an example portfolio and say how much I'm going to save versus bilateral? Then you go to a bank and you say, can you do analysis for me? And then weirdly enough, you'll probably get the same answer from two different, or kind of like completely different answers from two different counterparts. So you need to find that right balance from your own kind of like company perspective, which is best for you. But the good thing is that the option, you know, the rules are changing, but the options are there for you, you know, that weren't there 3 or 4 years ago.
Yes, yes, indeed. Well, speaking to our audience now, we have about 10 minutes to go. Questions are beginning to come in, but we would urge you to ask more. We have a terrific panel here to answer the queries that you might have. The first question that's come in alludes to a point that Casey touched on briefly. We'll get a little more detail perhaps from this, asking for more detail around Flexi Futures. Casey, if you want to say a little more about that product, and then perhaps I'll ask the other members of the panel what the practical merit is from your perspective. Casey, do you want to take that?
Sure. With pleasure. So what we did was back in 2019, towards the end of 2019, we introduced this Flexi Futures, which is a futures contract that is negotiated or traded bilaterally. Initially, it's bilaterally, now tailored for any particular broken dates that you want. So non-standard futures expiration date. You can go up any date from day 1 to 100 calendar days from today. When you trade this contract, you have margin offsets available to just like any other derivatives contract that we list. It's the same contract and settled the same basis as any of the standard contracts that we have. And the contracts is available, you know, to US participants because it's futures contract that is available, and that would actually help you know, participants who are, you know, we have talked about bifurcation of liquidity earlier on with SEF and non-SEF. This actually sort of provide a unifying value. What this does is that it replicates the economic value of an OTC contract. Right? It basically allows you to trade any forward date that you want, and because of that, the benefits that comes with it will be, you know, depending on whether you are banks or your buy side, CTAs, or, you know, it will basically help reduce your capital costs, reduce the counterparty risk because you'll be facing the exchange, and we are able to access new customers as well. So instead of doing an OTC trade where you need to paper ISDA and CSA with, you know, individual counterparties, you just need to have a clearing member do a KYC on you, and then you can post margin and you're off you go, you can trade. And you know, the best benefit of it is besides the fact that, you know, we have all this mentioned, you also have a very efficient futures format that allows you to net your position as opposed to living across as an uncleared. So I think this is what we do. I mean, we have had close to $600 million traded already. And when we're gonna basically introduce this further, we're gonna put it on a venue, or we have some partners as well who have venues that operate this Flexi already. So we're gonna see a more easy access for participants coming in. Hopefully this will take off even more.
Okay, so SGX has built it. Let me ask the others about what it means for you, if it's useful for you. Any of the three of you wish to speak to this? Just raise your hand in the air if you.
I can.
Okay, Mark, can I go to you first?
Sorry.
You know,
I was just going to say, I think it's a great addition to the ETD environment. In terms of practicality, it will be difficult for a market maker to be able to kind of extrapolate the whole curve for every each, you know, single OTC date. However, it would work in an EFP format where you can turn around and say, well, I want to do an OTC forward and then EFP it to the exchange.
Sure. Okay. Mark, I think you are about to speak as well.
I think it's a great product, you know, for the customers that need to go to a specific date. For us, we want to get exposure to a trend in the market. So whether it's the 16th of June or the 11th of June, it doesn't really matter to us. And when we're talking earlier about the challenges of the fragmented market, you know, there could be an axe that someone wants to trade in that 11th of June. So that's actually a better price at the moment in the market. But because I trade 16th of June, I cannot really do anything with the 11th of June. So that is that quality of liquidity challenge that we're talking about earlier. How do I access that 11th of June liquidity at that moment and then translate it into my 16th of June. Now, it could be an issue on our side. We need to be able to accept the 11th of June and run dual positions and what have you. But, you know, ideal world is that we can take advantage of that blip in that curve and turn it into the positions that we are holding.
Right. Okay. Interesting. And Richard, you have a view as well?
Yes, yeah. I mean, it's you know, I think it was alluded to there that the issue here is you know, the liquidity between the futures date and the OTC date. Now, we trade bilaterally, so typically what we do, we'll trade spot and then roll it forward post trade. But in order that we trade with the spot market and futures together, there has to be an interaction between and a validation of that the spot price is better in futures or in the OTC market. So there's a technological challenge there as well. You have to be able, you know, specifically when we're trading at the milliseconds, when we're trading with the algorithms, we have to, you know, check that that the prices are good. And so the speed is still a very, very important factor there. And I'm not sure that the technology is there yet.
No, fair enough. One more question that's coming. We've touched upon this, but perhaps we can mine it a little further. On the back of increasing regulatory capital for the trading of FX derivatives and swaps, what are some of the recent market innovations that can help meet the challenges of FX swaps for market participants? Now, again, we've covered some of this ground, but perhaps there's more to say. Anybody want to add to that? Okay, I'll stay with you, Richard.
So this alludes to, for me, this alludes to the peer-to-peer relationships and swaps. So, you know, there could be buy sides that have contra interest, and I guess the ideal situation would be that you would trade directly with your peers. Obviously, the problem that we have there is that within that you need some sort of credit conduit, or, you know, somebody has to step up for the credit there. So, you know, there are technology providers out there that, you know, we are working with at the minute, but typically at the minute, you know, that credit conduit for me at present is, you know, a bank at the minute. So there, you know, there's a lot of technology out there that's being built on, and I think, you know, there's some smart stuff, and I think going forward we'll probably see some interesting things in that space.
Yeah, interesting point. Anyone else? Yeah, Chris, go ahead.
I was just going to say that with the peer-to-peer thing, with the banks kind of like supporting it, there's going to be additional costs. So you've got those tech costs plus the additional kind of PB costs of the bank. So again, it feeds into that, you know, what's the most cost-effective, you know, cost of execution and cost of holding. Is that it probably in the first instance, and this is what we found with a lot of the ETD environment, the first, like, how do I put it? The first kind of like people stepping in, it's actually extremely expensive. Once the market becomes more mature, then you find that like kind of like the liquidity kind of starts to evolve, the costs start to decrease, and it's become a better kind of trading environment. But those first baby steps are quite painful.
Yes, indeed. Right. Okay. Another one. Again, this covers ground that we've touched on, but can perhaps speak more about. Does the panel agree that UMR has the potential of driving end users towards exchange-traded FX futures? Now, Casey, I think you have touched upon the fact that it probably does, or there are indications that it will. Do you want to expand a little on that, or what you expect to see?
Well, it's kind of difficult. I think, as I mentioned, it will probably, we suspect it will probably end up in a blended world where you have a combination of, you know, in fact, users will continue to use clearing as well as ETD, as well as remaining in OTC, depending on the trade combination that they are doing, and they'll continue to use you know, technology to help optimize that. In fact, what we have done to this end, SGX has partnered with a company called Cassini System that we offer, you know, a 5-day, 5-day or 5-hour consult service for free for participants and buy sides who need to have some guidance as to what they need to do as a next step, you know, in the UMR space. So this is something that we are offering to buy side customers who just need to find out, you know, some direction, some guidance on how to basically proceed to basically work in this UMR world that they will be subjected to.
Sure. Okay. Well, I believe we have come to the end of our allotted time, so it simply remains for me to thank all of our panel for their help today. That's Casey Lamb, Chris Callender, Nicholas Gregor, Mark Potter, and Richard Turner. Thanks also to my colleagues, Philippa Shipley and Valida Kajdin, for all of their help in arranging all of this. And with that, I will cross back to Philippa. But thank you all of you in the audience for being with us today. It's been a pleasure to speak with you all. Thank you.
Thank you, Chris. That was an educational session, to say the least. Thank you very much to our speakers for sharing their knowledge on FX futures and UMR. And thank you to our sponsor, SGX, for hosting this briefing. We will now be taking a short break and we'll reconvene at 10:30 a.m. for the Future Exchange Landscape 2021 panel. We will see you there. Thank you all.